Hey everyone! So today we're going to tackle one of the biggest ideas in investing from the last few decades. It's a strategy that's not about trying to outsmart the market or predict the future. Nope. It's about building something that can stand up to pretty much anything the economy throws at it. Let's get into it.
The whole thing really starts with this one simple question. What if you could actually build a portfolio that you didn't have to worry about no matter what was happening? I mean, think about it. A portfolio that could weather any storm, even the ones we can't see coming. It's a pretty radical idea, and it directly challenges how most people think about investing.
You know, for years, the gold standard for a safe or balanced portfolio has been the classic 60-40 split. 60% stocks, 40% bonds. It sounds reasonable, right? But lurking just beneath the surface is a really dangerous flaw that most people completely miss. And here it is. This is the big gotcha. You might have split your money 60-40, but you absolutely have not split your risk that way. See, stocks are just so much more volatile than bonds, like 3 times more. So even though they only make up 60% of your dollars, they're responsible for something like 90% of your portfolio's total risk. The point is, your portfolio isn't balanced where it actually counts.
This chart just makes it painfully clear, doesn't it? The fate of your entire balanced portfolio is basically tied to what the stock market does. You think you're diversified, but what you're really doing is making one giant concentrated bet that the economy is going to keep growing. So, how do we actually fix this?
Well, the answer comes from this really simple but totally profound insight from the folks at Bridgewater who came up with this. They realized you don't have to predict all the crazy, complex things happening in the market. Instead, you just have to focus on the 2 things that really drive the price of everything.
And boom, here it is. This is the big aha moment. It all boils down to just 2 questions. Is economic growth going to be higher or lower than we all expect? And is inflation going to be higher or lower than we expect? That's it. Those 2 simple questions create 4 possible futures, or what they call the 4 economic seasons.
Now this is where it gets really cool. This table shows how different assets tend to behave in each of those seasons. Every asset has a built-in bias, right? When growth is booming, stocks are obviously going to do well. But when inflation is taking off, things like commodities and gold are what you want to own. And when growth slows down and things get scary, government bonds are your safe harbor. The whole key is, since you have no idea which season is coming next, you need to own a little something that does well in every season.
So how do we actually build a portfolio based on this? Well, the goal is to create something that's genuinely balanced across those 4 economic seasons. And to do that, we have to start thinking about risk in a completely different way.
The tool that makes this all possible is called risk parity. It totally flips the old model on its head. Instead of putting an equal amount of money into each bucket, you put your money to work so that each bucket contributes an equal amount of risk to the whole portfolio. It's a real paradigm shift.
And the end goal is just so simple and elegant. You want to build a portfolio where 25% of your risk comes from assets that do well in rising growth, 25% from assets that do well in falling growth, and so on for inflation. If you do that, no single economic surprise can completely wreck your portfolio. When one part of your portfolio is getting hammered by the weather, another part is designed to thrive, giving you a much, much smoother ride.
So what does this actually look like for a regular person? Well, this is the all-seasons portfolio. It's a simplified version that anyone can use. And just look at how different it is from a 60-40 portfolio. You've got a huge allocation to bonds. That's to balance out the massive risk from stocks. And then you have these dedicated chunks for gold and commodities to protect you against inflation.
Here's just another way to visualize it. You can see the whole thing is built on this big foundation of bonds. They're the ballast that keeps the ship steady in a storm. And then you have these carefully measured amounts of growth assets like stocks and inflation-fighting assets like gold and commodities layered on top.
Okay, the theory sounds great, right? But the real question is, does it actually work in the real world, especially when things get ugly? So, let's put it to the test and look at some of the biggest financial crises in recent memory.
Let's start with the big one, the 2008 financial crisis. The S&P 500 got completely demolished. It lost over half of its value from top to bottom. But the all-weather strategy? It proved just how tough it was, falling way, way less. That huge bond allocation did exactly what it was supposed to do. It provided a cushion when stocks were in an absolute free fall.
And we saw the same story play out again during that insane, out-of-nowhere COVID crash in 2020. The stock market just plunged, down 30% in a matter of weeks, but the all-weather portfolio? It had a much smaller dip, only falling about 6%. It saved people's capital right when they needed it the most. Okay, but let's be real here. No strategy is a silver bullet. And if we're going to be honest, we have to talk about the strategy's worst performance in decades. Because recently, something happened that struck at the very heart of this model.
Between the end of 2021 and 2024, the strategy saw a maximum drawdown of 17%. That's a serious hit. So what on earth happened?
It was basically the perfect storm. To kill runaway inflation, the Fed jacked up interest rates at the fastest pace we've seen in modern times. This absolutely crushed the price of long-term bonds, the main stabilizer in the portfolio, at the exact same time that stocks were also plummeting. Having both stocks and bonds go down together like that is incredibly rare, and it was a direct hit on the strategy.
But, that really painful period has led to some important changes. The framework is now evolving to be even more resilient in what looks like a new economic era, one with higher inflation and more geopolitical risk. So this new adaptive model makes a few key tweaks. First, it now explicitly considers geopolitical risk when picking assets. Second, it brings in what are called productive assets, things like farmland or infrastructure, which are much better at protecting against inflation. And third, it's a little less rigid, focusing more on the underlying economic drivers rather than just static buckets of assets.
So as we start to wrap this up, what's the one big idea you should take away from all of this? Well, it really comes down to what people call the only free lunch you can get in investing.
And it's this. Real diversification isn't just about owning a bunch of different stocks and bonds. It's about making sure your portfolio is diversified across different economic futures. It's about being ready for all those different seasons of growth and inflation.
At the end of the day, the all-weather strategy is really an exercise in humility. It's about admitting that none of us, not me, not you, not the smartest person on Wall Street, can consistently predict what's going to happen next. So the smartest thing you can do isn't to guess, but to build a portfolio that's so robust, it doesn't need you to guess right.
And that really just leaves one final question for all of us to think about. When you look at your own money, at your own investments, are you really just making one big bet on a single outcome? Or is your portfolio truly honestly prepared for any season?